Hello, I'm Steve Higgins.
And I'm Allie Schmidt. We are the financial advisors and partners at HD Wealth Strategies.
And here we are approaching the 2020 election in what was previously an unimaginable environment. We rang in the new year back in January with an impeachment, and it pretty much went downhill from there. Presidential elections don't exactly bring out the best in a lot of us, and 2020 has provided plenty of emotional catalysts, especially when it comes to investing. Over the years, we have found that politics is one of the biggest drivers of fear and anxiety for our clients when it comes to making decisions about long-term goals and investments. Of course, for every person fearful of one candidate's potential effects on economic prosperity, there's another person awaiting the economic salvation from the very same candidate. Investors projecting the stock market's demise when President Obama took office were, of course, wrong. And those selling on the prospects of Trump winning the 2016 election were terribly wrong as well.
Our emotions, and it seems our culture, tells us that presidential elections matter when it comes to investing. However, the data tells us a very different story. A person who invested on election day in 2000 when George W. Bush was elected and held that investment until now would have experienced a return of 12.8% per year in the S&P 500. A person investing on the day Barack Obama was elected and held that investment through today would have averaged about 28% per year. And a person who invested on the day Donald Trump won the election would have averaged about 18% per year. Before these elections, Steve and I addressed many client concerns and predictions regarding the potential demise of the market, depending on each of the election outcomes. What may surprise you is that while elections bring out fear and emotions, presidential election years and the year following have been some of the best in terms of market performance. Let's look at the math. Steve?
Thank you, Allie. After analyzing data compiled for us by First Trust, we can see that regardless of party affiliation of the elected person, election years and those years following have a very good chance of being positive. Starting with Hoover's election in 1928, presidential election years have averaged a positive return 83% of the time, while only 70% of any given year since 1928 has been positive. The average return of any given year since 1928 is about 8%, while election years average positive returns of 11%. So what we know is that since 1928, election years have been 18% more likely to be positive than any given year and experience an average annual return that is 41% higher than any given year. Now, since this election year is almost history, thankfully, let's take a look at how the years immediately following presidential elections have fared with regards to performance of the S&P 500. Since 1993, the year following presidential elections has been positive 86% of the time, compared to all years which have been positive 82% of the time. The year following presidential elections since 1993 have averaged positive returns of almost 17%. So while contentious for sure, especially here in 2020, presidential election years and the year following presidential elections have, at least historically speaking, been some of the very best years to be invested.
So looking forward, we think it's incredibly important for our clients to be conscious of some other issues, and we think very real issues that could impact their portfolios. While COVID-19 and its economic aftermath are still very much present, we believe that we will continue to work through this problem and ultimately reach a positive outcome. However, 2020 will be remembered in the history books for more reasons than COVID-19. The traditional way investors have used and benefited from bonds has changed. This year brought with it the lowest yield on Treasury bonds in history, with the 10-year Treasury dropping to an all-time low of 0.5%, and the 30-year Treasury bond breaching the 1% threshold for the first time in history. This low rate environment should change the way fixed income, or better known as the bond component, of a portfolio and how it affects retirees and pre-retirees going forward. While these historically low rates have created the opportunity of a lifetime to refinance your mortgage, a lot of people are feeling it at the bank, with little or no interest being earned on cash. We thought rates on savings accounts and CDs were low before all of this. I think we'll be talking about the good old days of money market accounts at 1% now for the foreseeable future. We're focusing on how to deal with rates at these levels for our clients right now.
That's right, Allie. This is a substantial change that we did not anticipate heading into 2020, when Treasury bonds were yielding close to 2%. Where we stand today, with yields of less than 1%, it's tough to even call that portion of a portfolio income. This is compounded by the threat to the principal value of bonds. Interest rates and bond prices are on opposing sides of a teeter-totter, and when interest rates increase, bond prices decrease. So not only is there a very minimal income component to bonds right now, there's a strong likelihood that interest rates move higher over the long term and the principal value will also decline. There are a handful of analysts out there that are anticipating a 0% or even negative real returns on bond portfolios over the next 5 years. This simply is not our bond market of 10 years ago. And don't get us wrong, there is always a place for bonds or fixed income inside of a portfolio to provide stability and cushion the ups and downs of the market. However, it's more important than ever that we do not overweight these positions inside of our clients' portfolios.
That's a good point, and also actually brings us to another focus point that we didn't anticipate as we started 2020, and that's the likelihood of inflation. Over the last decade, we've averaged about 1.8% inflation. We think that's likely going to change. We're not anticipating hyperinflation like the 70s, but inflation closer to the historic average of about 3%, or even 3 or 4 and 5% is certainly possible. The cause could be the recent, and once again historic, stimulus year to date. We are not new to federal stimulus. If you remember, we had significant stimulus programs after the Great Recession that lasted through the end of 2014. But a lot of those dollars never hit Main Street. This time it was sent directly to mailboxes through the stimulus check to individuals and also through the PPP, or the Paycheck Protection Program. That's more money rolling around in the economy. In this chart, you can see what's called M2. This is the amount of cash or near cash in our system. Think checking, savings accounts, money markets, CDs, that type of thing. The amount of stimulus deployed as part of the COVID-19 response has already matched the total amount of stimulus in the financial crisis. And we're definitely not done yet. This stimulus has increased the money supply in a way we haven't seen before. Coming out of this recession, we'll likely have more money, chasing fewer goods and services, which is just the classic recipe for inflation.
So the plan? Own things that inflate. Think stocks, real estate, and hard assets. And we think it is more important than ever to tactically manage portfolios. Inflationary environments, our very short pandemic experience, and certainly presidential elections, point to a lot more market volatility no matter who ends up in the White House. And as always, we'll be diligent. We're going to use our disciplined investment process and focus all of our efforts on helping our clients plan for the long term and meet goals.
And in the spirit of the election season, and since I am from Chicago, I want to encourage you all to vote early and vote often.
Allie.
I'm just kidding. It's not who you vote for, it's that you vote. This has been a challenging year for so many, but being in the business of serving our clients has meant more to us than anything. From all of us here at HD Wealth Strategies, thank you.
Yes, and with that, I'm Steve Higgins.
And I'm Allie Schmidt. Thank you for watching our 2020 election video.